Off into our first real reading in the derivatives material here, which is this reading on forward markets and contracts. Now, as a preface here, if you are reading through your Schweizer notes and you go through the topic summary on forward rate agreements, or not forward rate agreements, forward markets, and you're following the pricing and the valuation stuff, and you're going through and you feel like you're getting the hang of it, and then you move on to the futures. Okay, and you say, well, isn't this what we just did? And the answer is yes. So the easiest description of a future, and we will have to refine this a little bit as we go through and when we talk about it directly, but remember, forwards and futures are conceptually the same thing. So these are just contracts for delayed delivery. That is, we're going to enter a contract today and that we're going to execute it in the future. So we're determining the price and the quantity today and the time at which we're going to make the exchange, but we're not actually going to make the exchange today in the forward/futures markets. Now, for both forwards and futures, the long and the short have the same notion. So the long position is, of course, going to be the buyer. So if you are long a future or long a forward contract, then you are agreeing to buy the underlying at some point in the future. So the long is going to buy, just like if I was buying something in the spot market. So, if I was going to buy a piece of real estate, I go out and I say, look, I'm going to buy this piece of real estate. What would I like to see happen to the price? Well, if you are buying a piece of real estate, then what you would like to see is that the price is going to increase. The same for a long position in the forward market. When you buy, you are locking in a price to buy in the future. You are hoping that when the future arrives, the price of the underlying will be higher than what the contract price is. So the long is going to benefit when the price increases. And of course, if the longs benefit when the price increases, then the short has to benefit when the price falls. So the short is a bearish position. That is, they're going to they will benefit when the price of the underlying falls. The long is going to benefit when it increases. Now, be very careful to understand what's in red here, and that is that neither party pays anything at initiation. So what does that mean? Well, essentially, forward contracts and futures contracts are free. You don't pay anything to get into those in the interim. You just enter the contract. When we talk about a forward price or we talk about a futures price, what we're talking about is the price at which we will actually exchange the underlying at some point in the future. So the contract itself is free. Okay, we're just locking in this contract for delayed delivery. You'll have to contrast this in your mind very carefully with options, where there, when we talk about the call premium or the put premium, we are actually talking about the value of the contract itself. So if you're talking about an option, the contract has value. Here, we determine a futures price or a forward price in such a way that it makes the contract value zero at initiation. So that's the main idea behind forward and futures pricing. Of course, we won't have to deal with that at level 1. That's going to be a level 2 topic. All right, so what about delivery? Okay, well, of course, in many cases, a forward contract is deliverable. So you can actually enter a contract to buy a T-bond in the future, and you can accept delivery of that T-bond at some point in the future. So that's delivery. Okay, there are times when there is an option for cash settlement, and there are also times when cash settlement is required. So for instance, if we have as the underlying asset an equity index, you can't actually deliver an equity index. It would require buying parts of shares of a bunch of different stocks and all those types of things. So delivery is just simply not practical in that case. And then in the case of something where delivery is not practical, then the contract will not allow delivery and will call for a cash settlement. So whoever loses will pay whoever is the gainer on that particular contract. So if I'm long, the price goes down. So I was betting it would go up and it would go down in a cash settled contract. Then we'll calculate the amount that I would have lost, and I'll simply write a check to the short to cover the fact that they've been disadvantaged by the price move. So they win, I lose. So that's the idea behind settlement. But what about early termination? Okay, so this is I think a more robust area of thought than perhaps what we do at the end of the contract. What happens if you get into a forward contract and you say, okay, I'm going to buy a bushel of wheat 90 days from now. So you're long a forward contract on 1 bushel of wheat, okay, that's going to expire 90 days from now at, let's call it $3. Well, what happens if you decide after 10 days that you don't like playing this game as well as you thought you did and you'd like to get out of it? That is, you want to terminate this forward agreement early. Okay, well, that is something that's fairly easy to do when we get to the futures market. So one of the advantages of having standardized contracts is being able to get in and out of them really quickly, but it's a little more difficult here. So what we could do, if I'm the long and you're the short, we could go through and say, look, I could come to you and say, I want to get out of this contract, and we could calculate the value that is inherent in the contract given the price changes over the period that the contract's been outstanding, and I could simply write you a check. So in other words, I could buy my way out. Although the counterparty is probably not obligated to let us out if we want to. So the counterparty entered a 90-day wheat contract for a reason. They were trying to hedge something, or they were speculating. They wanted to be in a 90-day contract. That's why they took the other side of our long 90-day wheat contract. They may not want us to simply get out. So this is not something that the counterparty would have to let us do in the typical forward contract. So what we could do, and what you might want to think about a little bit more carefully, is the idea of an offsetting contract. So if I get into a long wheat contract, again, I'm buying 1 bushel of wheat at $3 90 days from now, and let's say 10 days in, the price of wheat has gone to $3.50. So I thought it was going to go up. Okay, it has in fact gone up, so I am on the winning side of this contract at this point in time, but I also think that wheat has made its run. In other words, I thought it was going to go from $3 to $3.50. I don't think it's going to go any higher, and I would now like to get out of the contract, take my gains and go home. Well, what happens? I'm, of course, in this case, long a contract to buy wheat at $3. Well, what I could do is I could go in and short a contract that had the same expiration, which would now be, less than the original 90 days that we started with on the long contract. But I could go in and take a short contract at, let's call it the $3.50 that would be the price existing today. So if we wanted to look at this in terms of a timeline, so this is a 90-day contract. Okay, we are 10 days in, so we're here. Okay, and we originally entered a 90-day contract, so there are in fact 80 days remaining here, just to make sure that everyone knows what's going on. Okay, and when we entered the contract, we entered with a forward price equal to $3. Okay, and when we get to time 10, the price has gone to $3.50. Okay, well so we are long, we are agreeing to buy here for $3. Now the price is $3.50, so we'll say that we can lock that price in the forward market. Well, what happens if I now agree to sell? I enter an 80-day contract to sell at $3.50. So I've already agreed to buy at $3. Okay, so this is going to be my long contract, and now I'm agreeing to sell at $3.50. Okay, so that will be my short contract, abbreviated L and S. Well, what's just happened? Okay, it doesn't now matter what the fluctuation in the price of wheat is, with the exception of some counterparty risk, which of course could exist, especially we had these in from two different counterparties. I have agreed to buy at $3 and sell at $3.50. Okay, and if it's the case that the price of wheat goes back down to $3, I don't care. I've already locked in the price to sell. So what I've done here is I've entered an offsetting contract so that I've locked in my gains in this case. I could have also, if the price of wheat had gone down, I could have locked in my losses. If the price of wheat hadn't changed, I could have just gotten out of it altogether, right? So anyway, what we're going to see when we get to the futures contracts is that most futures contracts are in fact closed out by taking an offsetting contract. So once I'm long and short in the same commodity with the same delivery date, I have effectively put off all price risk. So to the extent that the price of wheat in this example goes to $4 at time 90 or drops to $2 at time 90, I don't care other than, okay, this one idea of counterparty risk, because this is a forward contract, not a futures contract, so there is some counterparty risk embedded in these contracts. So I could have one party default on the agreement, in other words, what we're saying here. So anyway, but that is the idea of an offsetting contract, and I think that's an important concept within the futures and forward contracts for this level 1 curriculum. All right, so what about dealers and end users? Well, the dealer is the one who's going to create a derivative contract, and then they're going to quote a price to either take a long or a short position. Okay, the end user is typically going to be a corporation or some other entity that is seeking to transfer existing risk. So, for instance, I have issued floating rate debt because that was the hot part of the market when I issued debt, and I'm worried that interest rates are going to increase. So I'm exposed to an interest rate increase. Well, what I could do is I could take a position in the forward market that would transfer that interest rate risk to someone else. So this would be a way to transfer risk between parties, and that is the prime use of the forward and futures market, that transferring risk from one party to another. Now, we can have raw speculation. Okay, that is, I don't have a fundamental position. I just think interest rates are going to increase, and I want to profit if that happens. Okay, but we're going to examine it, and we will talk about speculation within the curriculum as you go through the levels. But I think we're going to talk about it more in the aspect of hedging risk or transferring risk among parties as the primary use for these forward and futures contracts. All right, what about an example here? So if we're talking about an equity forward contract, so this could be on an individual stock, it could be on a specific stock portfolio, or it could be on a stock index. We're going to talk about stock index examples in particular. We'll see one here, but we'll also talk about the equity index futures contract when we get to the next topic summary. So, but it's just the idea that we're entering into a contract for delayed delivery. We're either agreeing to buy or sell a stock or a specific stock portfolio or an equity index at some point in the future. So as an example on an individual stock, we could have a forward contract to buy 10,000 shares of Acme Industries common stock in 90 days for $128,000. That is to buy it at $12.80 a share. So if I am currently holding lots of Acme Industries stock, I'm worried that there's going to be some price declines. What I could do is I could short this contract, and so I lock in a price at which to sell it. Okay? Or if I'm worried that the price is going to go up, I'm going to need some Acme stock for some sort of transaction, I could take the buy side of this where I'm locking in a price to buy. So an index contract payoff is going to be the notional amount times the percentage change in the forward index, or the difference between the forward index and the actual index at the time of settlement. So when we talk about an index, as we said earlier, remember these are going to be cash settled. Okay? In the case of the Acme contract, would depend on how the contract's written. We could actually call for delivery of 10,000 shares of Acme. We could also do it as a cash settled contract, and we could also allow the short side the option. Do they want to deliver or do they want to settle in cash? Let's look at an equity index forward. I think that's probably a little more idiomatic of what you might see on the exam. So here we're looking at a 90-day S&P 100 forward contract. Okay, the forward contract price is 525.2. So in this contract, the long is agreeing to buy at 525.2 and the short is agreeing to sell at 525.2. Okay, now when we talk about a cash settled contract, we usually have to have some basis for what the payoff is going to be. So that means we're going to assess a notional principal. So the notional principal here is going to be 10 million. What's the difference between principal and notional principal? Remember, notional principal, we're not actually exchanging the $10 million. We're just exchanging the payoff based on the $10 million, right? So the first three bullet points here above the red line that I drew in, those are things we know at the initiation of the contract. We know what the underlying is. We know the forward price is 525.2, and we're going to base payoffs on $10 million. Then when we actually get to time 90, that is at the expiry of the contract, the value of the index has gone up to 535.7. Who won, who lost? Okay, well, obviously, when you take a long position, you are betting that the price is going to go up, so you're going to win. So what we better see here is that the long is going to win when we compute the payoff. So the payoff is going to be based on the holding period change between the forward contract price and the actual price, and then what that holding period would imply for a $10 million notional principal. So looking at a quick solution, okay, well, we take the 535 minus 525, that's the change. We divide it by 525. What is that? Okay, well, remember, that's nothing but the holding period return, right? That was our definition for holding period return. Okay, so we're taking the holding period return here, and we're going to multiply it by the $10 million. Okay, that is the notional amount. What that tells us is there's been a $200,000 gain for the long. So at settlement, the long is going to receive $200,000, and that's going to be paid by the short. So anyway, so that is an equity index forward contract. Pretty simple to work with. Something that I think is something that you certainly should have a fundamental understanding of for the exam. Let's talk about a zero coupon bond. In this case, it's going to be a T-bill forward contract. So I don't know that the details on this slide are massively important. So it's a 100-day T-bill forward. Okay, the underlying is going to be a $10 million T-bill. Okay, so what that means is we're agreeing to buy a $10 million T-bill for this. If you take that discount, this is actually a 90-day contract. So it's 100 days until contract expiration. Then what you would get is a 1.96% annualized discount is where that comes from. But the main thing that I want to talk about is what's going on down here. Okay, so what does this mean? So what is the position we're taking if we are long in a T-bill forward contract? So we are agreeing to buy a T-bill in the future. Well, remember, if we are the buyer, so we're the ones buying the T-bill in the future, then what are we betting? Okay, well, we're betting that the price of the T-bill is going to go up. So the long is going to make a bet that the price of the underlying security is going to go up. So what is this is an interest rate derivative or an interest rate forward contract, since it's changes in interest rates that change the value of the underlying. So what is it that we're betting? Well, if interest rates rise, okay, well, there's an inverse relationship between prices and yields, right? So going back, if you've already gone through the fixed income material, then you're well acquainted with that. But if you're not, okay, remember that as interest rates go up, the value of existing fixed income securities goes down. So you're betting here that, well, if the interest rates rise, the price is going to fall. Is that what you want if you are long? Well, no, what you're betting if you're long on an interest-sensitive asset, that is a bond or fixed income security, you're betting that interest rates are going to fall, which is going to drive up the value of the security. Now, we need to be really careful here. That sounds relatively simple, and I guess in fact it is, but we're going to have two kinds of interest rate forward contracts. One of them is going to have as the underlying a bond or a bill. So in that case, if we're long, we're betting interest rates are going to fall. But the other kind is going to be directly on the interest rate. In other words, there's not a bond standing between our position and the interest rate. So if we are long a contract where the underlying is the interest rate itself, we're betting that interest rates are going to increase. But if we're long a contract on a fixed income security, because of this inverse relationship between prices and yields, we are betting that that interest rates are going to fall. Okay, so be really careful with that, because it does get a little bit challenging at times if you're not used to working with forwards and futures, making sure that you know what bet you are placing when you're talking about a long or a short position. All right, so what about a LIBOR-based loan? Okay, well, the whole point of this is to recognize that LIBOR is not a discount instrument. So when we talk about a LIBOR contract or a Eurodollar contract, okay, well, this is not going to be something that we buy at one price and it matures at its face value. Okay, so we're going to have a $1 million deposit, in this case, a $1 million loan, okay, but okay, it's going to be add-on interest. So if we're talking about a 30-day contract, okay, well, we're going to pay 6%. Remember, interest rates are always stated annually, so we're going to take $1 million times 6%, and then we're going to adjust for the periodicity of the contract. It's a 30-day underlying loan, so we're going to multiply by 30 over 360, or 1/12, and that's going to tell us that the interest on this is going to be $5,000. So the total payment in 30 days is going to be $1,005,000. This little fact is actually going to cause some modest consternation for us in the future. That is the fact that most of these types of assets that we talk about and we're writing contracts on are discount securities, and these are going to be add-on securities, so add-on interest, so discount securities versus add-on interest. So it's going to have some implications later, but for right now, let's just leave it at the payoff for this LIBOR-based loan. All right, so let's talk about forward rate agreements, or FRA. Okay, so I was a little, I don't know, disappointed is probably not the right word, but so we used to call the accounting material in the curriculum FSA. That was financial statement analysis. Now, of course, we've changed that to FRA, financial reporting and analysis, and I was a little concerned about that because we already had an FRA in the curriculum, a forward rate agreement. So make sure that you understand that a forward rate agreement and accounting are not the same thing, which seems obvious here, but if you're throwing around a lot of acronyms, as we all love to do in finance, then that can be a little bit challenging. So keep your mind on that. Anyway, so here we're talking about a forward rate agreement. If you understand swaps already, well, this is like a single period swap. Okay, so we're going to swap a fixed rate payment in the future for a floating rate payment, okay, but it's just going to be a single settlement instrument. That is, there's only one settlement date in an FRA. So the payoffs are going to be based on a notional amount or a notional principal. Okay, the fixed rate, of course, is what we're going to call the forward contract or the forward price. So the way we describe these is we're entering into a particular type of FRA, okay, and the price is 5%. That means that the fixed rate is 5%. The floating rate, of course, is going to be LIBOR. Okay, the long is going to win when LIBOR increases. Okay, that is when LIBOR ends up above the contract rate. So the long here, this is what we were talking about a minute ago when we said, look, if you have a forward rate agreement on a fixed income security, the long wins when interest rates fall. If you have a forward rate agreement directly on an underlying interest rate, then the long is going to win when interest rates increase, and that's what we see here. So if interest rates float up above, that is LIBOR goes up above the contract rate, then the long is going to win. Now let me give you some intuition about how to interpret this. And so think of this as the long position being having the obligation to take a hypothetical loan at the contract rate. So whatever the embedded loan is here, we're going to take this loan at the contract rate. And of course, what are we going to do? Well, if it's $1 million notional principal and we have a 90-day loan at stake some point in the future, okay, well, we're going to take a loan at the fixed rate. And what are we hoping to do with the money that we hypothetically borrow? Okay, well, we hope to loan it out at a higher rate. So it's going to be the spread between the contract rate and then the floating rate at the time of the expiration of the contract that is going to determine the payoff. So in terms of intuition, remember the long is agreeing to take a loan at the contract rate. The short, of course, is then under the obligation to make this loan. So the long is going to win when the reference rate increases. The short is going to win when the reference rate falls. All right, let's have a look at an example. I do think that these are perhaps I guess in my experience, I think of this as something that's overrepresented on the exam. In other words, in relation to the number of people that I've met that have actually traded these, there seem to be a lot of questions on them on the exam, or at least people complain that there are. Maybe that's because people don't understand them. But anyway, this is something I would pay attention to. So what we're looking at here is we're looking at a loan that's going to have an FRA that has a 30-day term. Okay, so 30 days from now, we've got a loan at stake that we are referencing here. The notional amount is going to be $1 million. Okay, the underlying rate is 90-day LIBOR, and the price of the FRA, okay, that is saying the same thing as the fixed rate, is 5%. Now, let's be real careful about what this means and talk just for a moment about notation. So we are entering a 30-day contract, right? So today is time 0, and the contract expires at time 30. That's what we mean up here by the term of the FRA. But the underlying is a 90-day loan. Well, the 90-day loan starts, okay, over here. Okay, so now we're going to have a 90-day loan period. So that's going to be, this interim period here will be for 90 days. Okay, but the total time until this is all over is going to be 120 days, right? So if we state this in terms of months, this is 1 month away. This is a 3-month loan, and this is 4 months till the end of the loan, right? Well, just for notation purposes, and people struggle with this, all right? But what we would call this is a 1/4 FRA. That is, the contract expires in 1 month, and the underlying loan expires 4 months from today. So this 1/4 means that there is a 3-month period in here. I probably ought to put months there, so 90 days is equal to 3 months. So we would call that a 1/4 FRA. All right, I realize that you might look at it and say, well, shouldn't that be a 1/3? One month contract and then a 3-month loan? That notation would have also made sense in my estimation, but that's not the notation that we're going to use. So it's going to be a 1/4, so you have to take the big number and subtract off the small number to get the interim loan. So if we had a 12/15, that would be a contract that expires 12 months from now, and then a 3-month loan beyond that, 12 by 15, right? Anyway, so just a quick word there on interpretation and notation, which of course both are important. Okay, so what happens to this contract now? So we're in this 1x4 FRA, okay, and at time 30, that is the expiration of the contract, LIBOR has gone up to 6. Notice that that is higher than the fixed rate of 5%. So who's going to win? Remember, the long position wins when interest rates increase. So you're long, you're hoping the underline is going to go up. The underline is an interest rate. There you go. That's the payoff, all right? Now, I have... in my experience, people do pretty well with the fundamentals of this and then kind of just fade at the end. So erasing the bottom part of the slide here, okay, the payoff is going to be fairly obvious. That is, okay, we are going to borrow money. If we are the long, what we've done is agreed to borrow at the fixed rate. That's 5%. Then we're going to, since we borrow that money, well, we're not just going to pay 5% interest and sit around and look at our money. Okay, we're going to invest it. So we're going to invested at 6%. So this is the spread between the fixed rate and the floating rate. Okay, we have a $1 million notional principal, and if you're Andy Holmes, the part that you forget is the time adjustment because you are under exam stress and that sort of thing. Make sure that you recognize that this is a 90-day underlying loan, so the interest rates are stated annually, so you've got to adjust for the periodicity, and what you find is that you have this $2,500 payoff. But what you have to remember here is that we think about this on a timeline. Okay, so here's time 30, the expiration of the contract. We enter the loan here, so we're going to borrow at 5%, okay, and we're going to loan at 6%. So this is where we get the 6 minus 5 as the spread starting. Well, in the instant that we do that, we don't make any money, right? The requirement for us to earn interest is a function of time. So this $2,500 payoff that we're calculating is at the end of this period. So we're going to get $2,500 here. Well, we could, and what we could do is we could just have it stated in our agreement that, look, we're going to have today's time 0, 30 days from now we're going to observe interest rates, we're going to calculate the payoff based on those interest rates, and we're going to exchange a $2,500 payment 120 days after the initiation of the contract. But that's not the way it works. Okay, what we're going to do, since we know everything about this payment, we know what the payment is, we know interest rates, we know everything about this contract at time 30, what we have to do is take one more step. Okay, that is, we have to take this and we've got to discount it back to here. Okay, that should be a straight line. Anyway, and we're going to do that at the current market rate of 6%. So we're going to discount this $2,500 back at 6%. It's this last step that I find that, you know, people get to this okay. Right? But then a lot of times they'll just stop there and they say, well, I'm tired, right? Well, if you're going to be tired, then don't come in and calculate this because you're not going to get any credit for it. So you might as well just save your time and work on another problem. You've got to remember that when you calculate the future payment, the payment at the end of the loan period for the FRA, you've got to discount it back to the expiration of the contract at current market rates. So what we would see is the correct answer. What's the payoff of this? Okay, at expiration of the contract, the long is going to receive $2,463.05. So this is that's the idea behind an FRA. So anyway, keep track of that. Now, remember, the CFA exam is different. Okay, you're much better off with understanding than you are memorization. Okay, but if you want to see a formula that would make this same thing work, well, here it is. Well, this is how we calculated the payoff, the $2,500 payoff at the beginning of the period, and then we discounted it back. Of course, days is the number of days in the floating rate term. So that would be something that you could use also. But again, I would suggest that you seek understanding and not simply memorization for the exam, because there's just too much stuff to memorize. The CFA is different in that way. So understanding, I think, is much better than just memorizing a formula. At the same time, I don't think it would necessarily hurt to put this on your private formula sheet. Okay, so to finish up this topic summary then, what about currency forwards? Currency forwards are pretty straightforward. It's just a contract that commits us to buy or sell a certain amount of a foreign currency for a fixed amount in another currency in the future. So I could agree. I am a U.S. dollar investor, but I could agree to buy and sell my buy or sell currency forward. So maybe I would enter a long euros contract. So I would agree to buy 1,000,000 euros 90 days from now. That means I would be long the euro. Well, if I'm agreeing to buy euros forward, then what am I hoping is going to happen? I'm hoping the price of the euro is going to go up, right? So I'm locking in a price today to buy the euro. I'm hoping the euro is going to go up. And, as with other forward contracts, these are typically going to be cash settled, okay? And the amount of cash that we're going to exchange is going to be from the gainer to the loser, okay? And it's going to be enough to compensate the party that was disadvantaged by the actual change in the market exchange rate as of the settlement date. So that is our idea of forward contracts. Okay, so if you don't have a good handle on forward contracts here, then I suggest you go back through this before you move on to futures contracts. So the futures contracts, what we're going to focus on there is essentially the differences between forwards and futures, and there are a few institutional details that actually lead to some things we'll need to talk about, but the underlying contract or the fundamentals of the relationships are exactly as they are here. So if you don't understand that, you're probably not ready to go on to the futures yet. So make sure you get a good handle on this. Good luck.